Good morning, good afternoon, and good evening to everyone, and welcome to this edition of Suntech's webinar series. I am Madhur Jain from Suntech, and I'll be your host for the day. To quickly introduce Suntech, Suntech is the world's #1 relationship-based pricing and billing company, and more than 130 customers across 45 countries use our capabilities to provide hyper-personalized products, offers, pricing, and loyalty programs to their end customers, 400 million of them. So the topic of today's webinar is retaining and growing customer loyalty with empathetic banking. What we will cover today, what the eminent speakers will cover today, are essentially how banks are dealing with the concept of customer centricity and moving away from the idea of products first to become far more thinking customer first. Our speakers will touch upon the challenges that the pandemic has specifically brought about and how banks have reimagined their approach to maintain the continuity of customer service to customers. We will also talk about how banks are doing on customer advocacy in terms of net promoter score and ways in which customer centricity can be driven from an operating model and a technology architecture perspective. Now, without any further ado, let's go into the webinar straight. And it is my pleasure to introduce the first speaker of the session, Puneet Kapoor. Puneet is the president of Products, Alternate Channels, and Customer Experience Delivery of Kotak Mahindra Bank Limited. Puneet heads the mid-office functions for the consumer branch, which covers a number of things, which includes the voice channel, the ATM and branch automation, currency chests, doorstep banking, deposits, debit and third-party distribution products, the priority banking program, and a number of other areas. So Puneet essentially is, if I would say, in the center of what Kotak is doing with their customers. And without any further time, over to you, Puneet. Please welcome, and we will look forward to hearing you talk.
Okay, so yeah, the topic customer centricity. It's not new in the context of service or banking. It's just that with the passage of time, it keeps taking different hues. Customer has always remained at the center. What surrounds the customer either comes up as a function of expediency or has some factors of permanency to it. But largely, the centricity is a continuum. It's not at a point in time. It cuts across the entire life cycle of your engagement with the customers. And it also comes up when you are stitching journeys around experience or when you're stitching journeys around value proposition for the customer. It becomes a lot more prominent. Experience, in turn, further manifests through what we now call as 3I framework. What does it mean? Customers come to the bank typically for either seeking information or they want to give an instruction. And if either of the two don't work well, there is an issue that they knock on us for. At each of these interventions, the way the entire journey map and the solutioning is stitched needs to necessarily keep customer at the center of it. Similarly, when we are talking about value proposition, value comes across essentially when you are engaging the customer either in a product conversation or when you are talking about certain non-financial value adds for the customer. So we will see in the subsequent slides how has the whole flavor of centricity evolved in the banking industry. But before we go there, I'd like to take a detour and something that Madhur said, as something which has happened in all our lives about 6 months back, Corona and COVID. And how did this development actually impact us? Has it made us change the lens? If you ask me, yes. And in fact, the whole conundrum and the puzzle between convenience and controls really got challenged. When I look back at our own organization, in the first 2, 3 weeks itself, we would have rewritten about 20 odd processes, to ensure uh, that the continuity was maintained and the need for remote engagement, contactless engagement did not create any friction in customers' ability to reach out to the bank or transact with us. It also led us into an extensive communication to reconnect and enable and guide the customers on DIY. DIY, as we all now know, stands for do it yourself channels. Yeah, because we realize that the ability to reach out to the branches or in any kind of a physical format is going to be a little challenging. There were a lot of customers who were not active, and it made all of us really do extensive communication in getting those customers activated again. We also realized that both our service and relationship teams are going to work in a remote format. So how do you enable them with sufficient and requisite information so that they can continue to service the customers and guide them correctly? Even the voice-based platforms had to be moved to a work from home capability. And it had to bring with it heightened vigilance, because in the normal avatar, the voice and the phone banking platforms are very strictly monitored in camera kind of setups. And now when you were working from home, you had to bring in higher vigilance on how the engagement was happening. While all this was happening, you also realized that it is also going to give opportunity to the not so good elements to strike harder. And so there was a much higher decibel level around safe banking as a concept. And I'll come to safe banking in a second again. Something which was already work in progress, actually the COVID-19 period only brought it to the forefront, which is the whole concept of video KYC. Pre-video KYC days, a journey of account opening could take up to 5 to 6 days for the final checkbook and a debit card reaching the customer. But with the advent of post KYC, we could now shrink it by another 2 to 3 days and reach it faster to the customer. And it really helped. And there are a lot more use cases around video KYC, which also, in a way, meet the requirement of contactless while still fulfilling the end result. So that also happened. And there were learnings around it. You understand a whole new gamut around technology intervention. Coming back to what I alluded to safe banking, it was not just limited to one SMS a fortnight. We really had to scale up our entire soundbite, connect with the customers across multiple mediums to ensure that, in the laziness of this phase, with people sitting at home, they just don't, give in to something nefarious and all. And we had to do a lot of build up around creating noise to keep your bank accounts safe. So that's what COVID made us do. Going back to the core of the subject, which is centricity, there are various ways, as I said, centricity can manifest itself. The first one, and I'll elaborate on the topic through the medium of 3-4 illustrations. The first one is when we change the lens from looking at customer as a single omnibus entity to who is the customer. And when we in the context of individuals, who is the customer can take various flavors. It could be a student minor, it could be a housewife, salaried, senior citizen. Question comes up, why is it important? A customer is a customer. No, it's important because this kind of a segmentation helps us to understand needs of each segment differently at different stages of their life cycle. Similarly, when you shift the lens from individuals to non-individuals, Again, does the customer take a different avatar? Answer is yes. It's either a sole proprietor or a partnership private limited company, Hindu undivided family, probably government departments and government organizations. Again, does the segmentation help? Answer is yes, because it helps you to understand the unique needs linked to their constitution and business lines, and you can reconstruct your service workflows linked to their specific and unique requirements. Now, one thing is to do this kind of a segmentation. Second is, does it also help? Answer is yes. Have we seen a difference? Answer is yes, we have seen a difference. When we shifted this lens from customer to who is the customer and connected basis who you are, it has given us lift across various business parameters that we usually track to check whether what we are doing is right or not, whether the customer is appreciating that, and how does that appreciation uh, convert are through some of these measures that we track, which is whether it's the wallet size or the product holding, whether the customers are more engaged with us. And we have seen varyingly a significant lift in the customer behavior towards a representing positivity when we reach to the customers, when we connect with them for who they are. It doesn't frankly end here. You can take it now to the next level, which is where you now say, fine, I have segmented you, but beyond the segmentation, can I give you a further identity? And this is what we have done, like many other banks in the industry, where you give a further unique identity and package the proposition. So for the women customer, we have something called a silk program. For a senior citizen, we call it grand. For a minor, we call it junior. And there is a direct connect and an affinity to the gender or the segmentation. And we have seen again, varyingly, it gives us significant lift when we engage the customers through a very, very sharp lens for who they are. Another flavor that comes in when we talk about centricity is very interesting, actually. And at times it only takes to switch one word. Believe me, it only takes one word to bring the whole perspective change in the concept of centricity. For example, we talk about insurance and but what is the purpose the product of insurance fulfills? It's actually protection. So when you shift from insurance to protection, does it help? Insurance, as Madhur also said, is a very product centric approach of connecting with customers. But when I shift the lens to protection, I don't have to engage customer multiple times in different products. I have one theme, and under that theme, I can talk a whole range of products to the customer. Yeah, that's the shift it brings. Let's take example of another product, a mutual fund or a term deposit, versus when you reach out to the customers with the lens of financial planning. How does it help? A product centric approach, as we saw earlier, is again making you interact on a single product instance. The moment you shift the lens to a theme, you are able to converse with the customers and engage them around a whole new goal-based conversation, and that then allows you to fit the right product for the right goal or objective with which a customer may want to be wanting to save his money. And this conversation can actually further go into the realms of text planning as the case as appropriate. So it just opens up the whole canvas and brings customer in the focus. Let's take a look at one more illustration. Foreign currency card. Yeah, every time you now travel, it's a ubiquitous product to be in your pocket. But when you are engaging the customer, is it only for foreign currency card or is it for travel as a theme? Because when you bring travel as a theme, then there are lots of other softer elements which come into play. You know, till some time back, we had this habit of switching off our India SIM card when you would travel, and we'll take a Matrix card or something as a calling card. But the fact is, your India card is where all your India SIM is where all your transaction alerts, etc., are coming. You cannot afford to switch off those numbers. Yeah, but do we speak to the customers about that? Similarly, today you have a flexibility of increasing or decreasing the limits, and when you are overseas, there is a higher risk quotient. All these things, get covered in a conversation mode the moment you have moved the lens from a product to a theme. And this we have seen does elevate the overall customer experience. One last illustration, which is around communication. Uh, Over the period of time, digital and everything digital has taken over everything physical. Yeah, and when it comes to communication, obviously SMS and email rule the roost. Uh, but we all know what's the click open rate of emails that we send, what's the response rate on the click on the open email rates. Yeah, uh, we know the instability of the telecom networks at times. The SMSs don't get delivered or ignored. Does that create an handicap? Or there is also merit in understanding a customer's channel affinity and then connecting with the customer through the channel of choice, and not necessarily limiting yourself to the overstated mediums that have come into play today. And there is a lot of merit in that, because when you look at your database and when you do data analytics, and you realize there's a huge set of customers which still believes in the power of physical connect. Isn't it a good idea to therefore converse with them on those channels where they are more comfortable? This is another illustration of how, when you think customer, you redesign the way you present your services and products to the customer. Summarizing it, so how did we move the needle towards centricity? It's essentially by changing the lens from what is in it for me versus what is in it for the customer. And every time we have changed this lens, moved it from me to you as in the customer, it has allowed us to look at things differently, allowed us to stitch the experience journeys differently. And of course, it has always translated into a much higher positive customer engagement as well as advocacy. Now, is it all manual, or is there also a play of technology here? Of course, technology plays a very large role here. And I'll show you one illustration of how technology comes in and helps us in creating that centricity even sharper. For example, you would have done some propensity analysis through certain algos, etc., and linked to those propensity analysis, your recommendation engine gives a hierarchy of products that you would like to engage the customer with. Now, certain event happens, and that event tells you that there is something significant changed in the customer's uh, life cycle, economic condition, whatever it may be. And the hierarchy of product probably needs to undergo a change. And the recommendation engine automatically resets itself basis that additional input. And now you are able to converse with the customer in a far more recent and contextual manner. Yeah. As we go forward from here, uh, technology is only going to become more prominent in guiding us, in delivering solutions which are increasingly more customer centric, because contextual intelligence is what will frankly differentiate on how customer reviews us and responds to us between one service provider and second service provider. Thank you.
Puneet, Thank you very much for that insightful session. And I particularly liked, I must say, the illustrations which you gave, which brought it out extremely clearly what you meant by moving from a lens of a product to a lens of a customer and looking at it from a customer's perspective. Thank you very much. And let me then now introduce our next speaker, Avishek Nandy. Avi is a partner based in Singapore, so the Singapore office of Bain and Company. He's an expert in the firm's financial services organization and strategy practices and holds a deep expertise across the financial services sphere, specializing in wealth and asset management, private and retail banking, as well as in insurance. His main focus is on strategy and full potential transformation of organizations with specific focus on on the digital transformation itself, organization design, and customer strategy and marketing. Over to you, Avi.
Okay, thank you, Madhur. Okay, it's great to be here to be sharing our perspectives on customer centricity. So I think Puneet really set it up well and then provided some really nice perspectives on what customer centricity means. And I think some of these concepts and principles are really sort of, takes us to some of the first principles of how we should be thinking about customer centricity. So what I'll do is I'll build on that. I'll build on that and I'll focus on more on the how moving forward. Yeah, so banks, I mean, this is, moving forward, banks are facing unprecedented level of change. And I think this has been happening for a while now. I think the pandemic really has put a lot more spotlight on this and created the need to accelerate that change. So customer expectations are shifting. I think in the past, there was already a migration to sort of digital channels, but with the pandemic, that has gotten accelerated, as Puneet was talking about. Technology obviously is making things possible that was not there sort of 5 years back, and fast and agile digital challengers with new business models are coming in, where incumbent banks are really have to rethink how they go to market and maintain their competitiveness. So I mean, sorry, I think there's a bit of a lag in the slide. So the how is a lot more harder than the what. I think if you ask most of the companies and the executives, they'll always say, yes, we agree, we need to do this. When it gets translated into the how, I think that's where a lot of the challenges come in. So I'd like to share with you our framework on what we call simple and digital. And the idea is to really put customer episodes and customer experiences at the core of the overall block of the house, and that really everything else needs to really be built around this. So you need the vision and roadmap, which requires, okay, what is your business model? I think you have to kind of rethink the business model in the context of new challenges that you're facing. What is the value proposition? How are we going to really differentiate? You have to think about propositions which need to be modular and more digital ready, rather than trying to take your old propositions and trying to fit into a digital world. You have to think of the channels, as Puneet mentioned earlier, around which customers. It needs to be a multi-channel environment for sure, but what customers are going to expect a lot more is a seamless experience and the same experience across. So if they start off with one channel, and if they move on to another channel, you can just pick up from where they left off. And then I think that's quite important. And orchestrating that is never easy. And then behind that, there sits, of course, what we call the Net Promoter Score, which is our focus on customer loyalty and how our companies serving the customers and a measure of that. And it's not just a score, but the whole system that is put around it to make that happen. And I'll sort of talk about that in a bit more detail later. It's also about operating model changes. And as I said earlier, technology is the easy part here, because technology is available, it's commoditized, it's easy to implement that. But how do you really align your organization and your operating model around that? I think that's quite important. And on technology, there are choices around, of course, what technology, but also more importantly, what needs to be the overall architecture, and how can you think about your technology roadmap in the context of the commercial roadmap. So what I'll do is I'll focus on number 5, 6, and 7, which is focused on the NPS, and then on organization and operating model. Sorry, on technology. On Net Promoter Score, just for those who are not familiar what Net Promoter Score is, it's a simple question. I think this was invented by Bain, and this is about asking a question around how likely are you as a customer to recommend that particular company to a friend or relative? Because we do believe if customers are willing to refer that company to their close friends and families, they are loyal to them, and that's a very simple indicator of what the level of relationship we have and how are we addressing those customer needs. And so we asked them that question on a scale of 0 to 10. 9 and 10, we really set a high bar on what a promoter means. It needs to be really high in 9 and 10 category. Anything below 6 is a detractor. Anything between is passives. And the score is really calculated as percentage of promoters minus percentage of detractors. And banking companies and banks in general and financial services broadly have struggled with this. They've traditionally had very bad, almost negative NPS scores where the detractors were a lot more than the promoters. And we've all had our own experiences with that. But I think over the last several years, as banks have invested in technology and customer experience and the overall organization, I think we have seen some movement, upward trajectory on that, which is great. So NPS has a very clear linkage to, sorry, I'll go on to the previous page. NPS is a very clear linkage to economics. So what we have realized over and over again, and this holds true across industries globally, we have had this measurements done for the last many decades, and what we have seen is people who are promoters tend to stay longer, so you're able to retain those customers. They buy more with you, and they refer more. So you get really a flywheel effect from building customer loyalty. The Net Promoter System is something that is put around the Net Promoter Score, but the key here is to, what you see in the middle is what we call the high velocity feedback loop. It's not just about that score and what customers think of us, but how is that then channeled back within the organization to be able to then make improvements and address those. And the more quickly we can do that, the better we'll be and be able to address that, and we can really leverage that. So there are two loops, what we call like the high velocity feedback loops. One is the inner loop, and the other is the outer loop. The inner loop is focused more on the front line. So as the feedback comes in, it's not just about something that goes to the head office and then we decide on what needs to be done. I think that's too late by the time improvements come back. So the inner loop is really important to have that at the front line, the information readily available back to the front line so that they can act on it very quickly. And the outer loop is there are things that the front line cannot address fully. So for example, if customers are asking for certain products or any issues with the existing products that needs to be addressed, or something related to a customer experience and the technology that sits behind it, that needs to be obviously addressed by the central teams, and that's where the outer loop comes in. So I'll talk about next about operating model. And in operating model, there is a lot of talk about agile, right? Everyone, I think that has almost become a fashion statement almost, where every organization thinks about agile, and it's not easy to sort of get done. And the companies typically grapple with how far do we go on agile? Like, do we try to do enterprise-wide agile, or do we do agile in small pockets, etc.? And people are taking different approaches. Here you see three different approaches. Some people have taken the big bang approach, like I'm going to go agile very soon across majority of the organization, and you kind of see a spike in that, and there is a whole top-down effort in sort of making that happen. Or there is a second model where people start slow, they start to experiment in small projects, more strategic projects, and as they get more confidence and build more confidence and some successes around it, they then scale that up. And then third model is where many banks have decided to almost put a separate engine, what we call engine 2 versus engine 1. You can think of these as a separate digital bank, where, rather than trying to work within the existing organization, they have tried to then set up something separately, so they're not constrained by a lot of the legacy issues. And there are challenges across each of these. We do believe that the model in the middle, I think that's where we have seen clients get the most success. I think model 1 has a benefit of creating a lot of momentum very early on and a lot of great sort of results early on, but sustaining that, I think there is a level of fatigue that comes in. And if the organization is not ready, I mean, this is about, Agile is about a huge behavior change in terms of how business is done and how work is done. And creating that early on might create a lot of momentum and commitment, but people have still not gotten used to that. And then I think that shows in the results, and we have generally seen the impact of Agile in a big bang approach taper off after a while. Whereas in engine 2 and engine 1, a third model, people have done that successfully. It's very actually very easy, maybe not easy, but like much relatively easier than doing it in the main organization. But what typically is the challenge is, how do you then take that from an experimentation mode or a separate standalone business mode to integrate that back into the core? And then I think that's where a lot of the challenges are. With number 2, I think it's about, I think the key there is, to make it really work, there needs to be a very good stage gate process where you can go slow initially to really build some of the successes with smaller teams and in small projects, but after that you have to really see how we can scale that up, and then having some of the capabilities there to scale it up is quite important. And there is definitely a risk of backsliding typically that we see. So I'll talk about technology then. The next slide first. Sorry, there's a bit of a lag. Yeah, so I think technology is obviously quite key in all of this, and banks need to increasingly think about themselves as tech companies with banking licenses rather than the other way around, where banks be enabled by technology. And the next generation of banking technology is increasingly clear and more accessible. I think that, as I mentioned earlier, that's not really the problem here. But there's no silver one solution, right? I mean, silver bullet that can achieve that. You really need to orchestrate and put different pieces of the building blocks together. And I can maybe, in the interest of time, I'll just go to the next page. So here, I think it's important to align on a few things. First of all, the why. The technology strategy or the technology architecture needs to be linked very, very closely to the business strategy. And of course, this is kind of normally what we've always said, and then sort of in the past as well. But it becomes more important, especially with so much changes happening on the business model side. And I think that needs to be translated into sort of what does it mean for technologies. For example, from a business standpoint, what are the key drivers? What are the priorities that the company is focused on? Is it customer experience? Is it next generation products? Is it cost? Or multiple of these, right? And depending on what the priorities are, the starting point on which parts of the architecture you start to address will be different. So there are different archetypes that we see in terms of how banks have addressed different parts of the stack. And some banks have taken a full, I'm going to take a overall front to back transformation, and I'm going to do address every single block in the architecture, whether it's the front end, the customer services layer, or is it the product engines, or is it the core banking systems, data integration layer, APIs, everything sort of, it's a full multi-year transformation journey. We're going to tackle all of these things. I think for banks who have gotten on this journey a bit earlier, say 5-7 years back, I think they had the luxury to think about that and take the time to do that. But now we are increasingly seeing, quick results are key, and banks are starting to realize that, look, that holistic transformation needs to happen, but they need to prioritize certain parts of the architecture. So if it's more customer experience focused, we have seen many banks start to think about, or many companies start to think about more of the front, the UI UX layer and the customer services layer, to sort of really address the customer experience, rather than waiting for whole modernization of the core, unless it's absolutely broken, right? So there are different approaches that people are taking, or certain players who are more focused on product differentiation. They are focusing on the replacement of the product engines and modernization of that. So different sort of parts of the house, of the architecture, technology architecture, needs to be addressed depending on the business priorities are. And then finally, I think this needs to sort of obviously link to very clearly to a roadmap, which absolutely needs to align with the business roadmap, what that is. And this needs to be orchestrated together with the business. The entire house that I showed earlier needs to be thought through together. So it cannot be sort of technology or IT having their own roadmap and they're going to go along with it. It needs to be closely tied and almost operate almost side by side with business to be managing this, because priorities will change very quickly. And you know, that sort of agility is quite important. So it can't be organizing and managed in silos. It needs to be done in a lot more integrated operating model, in a two-in-a-box sort of a platform model in many ways. So those were kind of my main points here that I wanted to share. I know it's a short time and then lots to share, but sort of the key learnings is it needs to be holistic. The transformation needs to be holistic. We need to think through all the different blocks of the house, not just one part. It needs to be both today forward. What does it mean is like taking today's business and improving it, but also thinking about future back, of what are the possibilities in the future, what the sort of the future might look like, which we have to imagine, and then work backwards to see what needs to happen. So it needs to be both. There are choices and priorities need to be set. You can't be achieving all of them, whether it's from a business standpoint or from a technology standpoint. IT needs to be involved from day one as an enabler. It needs to be joint accountability with business. The technology roadmap and the business roadmap need to be tightly linked, and the choreography is quite important of how all the different pieces need to be managed. So the program managing this whole piece is really, really key. So I'll just end there and leave some time for questions here.
Thank you, Avi. I think it's now time for the Q&A, and for the participants, attendees, you can still post your questions in the question panel while we take it up. The first question is to you, Puneet. Now, you illustrated with a very good example. For example, you took the idea of travel versus a foreign exchange card, right?
Yeah.
When you move it from a product to a customer or journey fed or customer focused approach, question here is very clearly, you also talked about a SIM card, right? How do you shut down a SIM card? And so typically what you said was that the experience of the customer is beyond what the products and services what a bank provides, and is much larger, especially when you move away from a foreign exchange card to travel. So what is the importance of third-party products and services in this overall experience with the customer, and how do banks deal with it?
Okay, so when talking about third-party products, basically saying para-banking, the products which banks don't manufacture themselves, as what they distribute,
Correct,
which is
insurance
or investments, etc. Right? Yeah, so that's where, if you go back to one of the illustrations, which was around, financial planning and meeting the different goals of life, etc. There's a question of knowledge. There's a question of accessibility. There's a question of how and where, and all these things under a single umbrella, banks are able to present to the customer. So when you're engaging with the customer, you are able to give them a single window interface and a platform to engage and help them fulfill different needs of their life cycle and objectives, and also give them a flavor of an open architecture, which makes the choice little more liberal. You are not boxing them in on a particular product suite it's only, and present everything from a single view flavor. Keep engaging them periodically on how the money pool that was channelized at a point in time has moved from time point A to time point B. Does it need a rebalancing? Does it need a review? So when you come in, quote unquote, in your avatar as a banking service provider or a banking relationship manager, frankly, the boundaries of engagement are unlimited.
And what does it mean to the banks? It's just a continuation, Puneet. What does it mean to the bank's risk and revenue profile? Because obviously now you're taking in third-party products as well in one sense. So there is a brand plus other risk coming in. And also, of course, there's an impact on the revenue side. So what does that mean?
So banking, we know, is a very highly regulated industry that we all operate in. And when you move beyond engaging with in just banking products, then you're also inviting focus from the other regulators, whether it's IRDA or SEBI or whatever. Regulation and adherence to regulation. And when you talk about the non-banking products, the phrase which actually comes up as the most prominent go-to phrase is suitability and appropriateness. So your entire engagement with the customer necessarily has to conform to the suitability and appropriateness of the product for that customer as an individual. And you get into the context of segment of one kind of a engagement. Profitability follows. Yeah, it's first, what is it that you are serving the customer for, whether it's correct and whether it's within the realms of the regulations that are aligned to that engagement, and then of course the profitability will come in. If your engagement is right, if you have serviced the customer right, then whatever is the revenue pool mapped to that kind of a product line will automatically accrue to you. You don't really have to work differently for creating a profitability pool there.
Understood. Thank you. Avi, question for you. Banks have, of course, especially banks in Asia Pacific, have moved to a customer-centric approach a few years ago, and some you could see a few pioneers in this geography. Kotak themselves being one. Now, does the law of diminishing returns come in here in the sense that as you keep personalizing, going beyond segments to sub-segments, does the investment in technology, which you spoke about, modernization or transformation, and that is inevitable, how does that play with the increasing or diminishing returns, additional returns coming in from customers in that sense of the term, be it increase in wallet share or profitability otherwise?
Yeah, so I mean that's a good point, right? And I think on this, I would say the solution is not so much in technology. Technology will only help you as much, and after a point in time, most banks will have a very similar technology, very similar type of capabilities. So there will be diminishing returns because differentiation will come down, right? And really the key there will be, it goes back to kind of the people aspect of it, right? And as technology takes over, it's what's going to happen is the focus on the people capabilities, advisory capabilities, like what Puneet said. So for example, in wealth management, you are going to be able to sort of differentiate through the level of advice that you give clients. Or if you're talking about a contact center that where you have automated sort of 80% of the volumes, 20% of it is about those complex issues and how good you are at solving them. And I think that's going to be, in my mind, a key differentiator, and we should not forget that, because that's I think the key here is there's a lot of focus on technology, and everyone is spending money and effort and time thinking of those, but probably kind of at the expense of the people, because we all think that this is going to enable productivity, this is going to enable capability. But if we are not able to shift our workforce and the people into that new model. So for example, in branches, right? I mean, you had tellers, you had sellers, and with technology coming in, tellers are going to go away very soon. So what happens, and even the sellers, I mean, there's going to be a lot of digital sales coming in. So they are going to become, what people need is going to be digital advisors or digital ambassadors. They're going to become advisors on very complex products where people need like wealth management or let's call it investments and protection. So that's going to be quite key, I feel. The ensuring the people are also shifting with it.
Thank you. There are quite a few questions, but I know we will be running out of time. So I'm going to ask a couple of questions which are around data and coming from different people, and trying to merge these questions into one single question, Puneet, specifically for you. Very clearly, data is very important when you spoke about machine learning algorithms and looking at the customer. How do banks actually use this data to understand the customer better is one part of the question. And the second part of the question is, in an increasingly private world, in one sense, where regulations otherwise are driving privacy more and more, how does this play out? Are customers happy to actually allow you to use their data, or is it that regulations are different from what customer expectations are?
No, it's a question of what are you using the data for. So long as you are not being intrusive and you are not getting into the privacy of the customers, so long as you are using the data to only read and connect with the customer with a superior proposition, we have not found any adverse or exceptions coming up linked to that. The question is, when you try and bring non-proprietary data into play, and then take that into a communication to the customer and a kind of camouflage it of how you have managed to get this insight and what are you trying to place through that insight, is where you are crossing the boundaries. But when I am using the data, which is within the four walls of my organization of what the customer is doing with me, and I'm bringing intelligence in that data and then converting it into a communication connect with the customer, it's perfectly okay. And that's actually creating
Understood.
a difference. It's actually creating a difference. If I can take the liberty of showing one more illustration, for example, any bank typically categorizes the kind of queries and issues that the customer present to you, right? Now, you have collected statistically relevant denominator, and then you realize that this kind of query tends to not get resolved in the stated or the promised time frame. Now, there are various ways to handle it. One is that you go back and see whether your frontline and the back office people are properly trained. Are they not understanding the concept, or is it that the flow of data is slow, etc.? And you can think little differently, which is you realized that this kind of query does tend to get derailed. You create through your technology algorithms, you create an intervention. Next time this kind of query gets logged in, it creates an alert. And you can do a preemptive intervention and try and smoothen and fast track the resolution rather than continuing to allow the current stated flow and probably not being able to strike on advocacy with your customers. So there is absolutely clean and more efficient opportunity of using data without breaching any boundaries.
Understood. Thank you. Unfortunately, we've now run out of time. For people whose questions are not answered, we will make our the best attempts to answer them offline with the help from Puneet and Avi. Thank you, Avi and Puneet, for this wonderful session. I think the insights were extremely helpful to the audience. For all the attendees, thank you very much for attending.